So with the stocks trading at or near records, it begs the question, should banks get re-rated or are they fully valued right now? Let's bring in Tom Michaud, CEO of KBW, a Stifel company. We're bringing him at the top because
this is real news.
Because he deserves
Tom, man.
Thank you very much. Thank you.
So we'll start off with you. It does feel like we're at a moment where you can believe in the virtues of deregulation, what the banks will be able to do now with regulators off their backs, but at the same time, there are these underlying credit concerns. How do you view valuations at this point?
So first of all, the fundamental story is very good. Mm-hmm. There's a broader narrative, which is we think earnings per share are going to be 13% higher next year. We are raising estimates for most of the banks. Just the revenue side is good, the expense side is good, and the pipeline talk is good. I'll tell you, coming into the quarter, there was a lot of concern about credit. We had the First Brands bankruptcy, the Tricolor bankruptcy, and there's concerns about consumer subprime credit. The numbers that we've seen so far, we were expecting benign credit costs. I'd say they've even been better. So the story out of the banking industry is that credit continues to remain very solid. Now, I heard you just play Jamie's comments. The reality is the industry is currently over-earning on credit. A lot of our provision expectations are about 25 basis points. That is too low. The industry's over-earning on credit. It will go higher at some point. The question is it manageable? We think it's manageable. We haven't seen anything that scares us on the credit side. But there will be credit challenges in financial services. We've had a huge run in private credit, and I would look to the financial institutions that have grown the fastest as possibly the places for the most risk. Over my career, that has always been the first place to look, and I think it still is in play today.
What are those areas?
Well, it would be private credit, and I don't mean to throw an arrow at the whole sector.
Sure.
But but that is where I would look, just because of the growth rate that they've had. They've grown so quickly in the last 4.5 years.
M&A activity was sort of what we heard at the beginning of the year. Now, over the last couple of weeks, we're starting to see it. Continuation into 26, because that's part of the bull case as well.
I believe it's going to happen because we have a confluence of many forces that would support it. The economy's in good shape. The stock prices are in good shape. And also, consolidation has been working. Generally, scale has led to more profitable banks that are more highly valued by investors. So those are the drivers. But I'll tell you, it is night and day in Washington. We had seen mergers that had happened that would take 16 months to get an answer. If you get an answer, you're now getting an answer within the 6-month time frame. That's been the case for the last 4 decades. So you're getting a reset to a more traditional approach to consolidation, which, frankly, I think the industry thinks it's a little bit on the clock. Because as the president emphasizes that all these agency heads work for the president, it means the next president will probably be in the same position, which means to the industry, if you feel like you have a pro-growth administration, you probably ought to act now. And I believe that's some of the thinking.
So let me ask you something about re-rating in the context of Bank of America's results, which I thought were excellent on so many fronts. All the big ones that we've seen about, M&A business and capital markets. Also, the credit quality was better than thought. So it's now trading at 14 times earnings, which is high for this. But we're at a market now that's 24 times earnings. So we know there's always a big discount between bank multiples and S&P multiples. Where could you see a multiple for something like a Bank of America?
So it gets to something that, like Melissa was talking about earlier, which is that these stocks are trading near all-time highs. But I think that if I were to boil it all down to one point that they made, which is return on tangible common equity, okay? That is, we think, the main driver for valuation relative to book value. And Bank of America today alluded to the fact it's likely to reset the target. It's having its first investor day in years in 2 weeks in New York. Citigroup, after many years, is having an investor day. They're not doing that to give bad news. They're doing that because they're really positive, and usually at these investor days, they reset. Wells Fargo reset. So you're seeing these banks, which are major, broad corporations, say, we think our business models are going to drive more profitability. I think that's how you re-rate. If you look at the relative PE multiple of the market, like you just said, we're still 30% cheap to the market. We still think there's upside in these stocks. And don't forget the dividend yields. Citizens raised theirs 9.5% today. That's not a minor bump.